Hey everyone, welcome to the Elite Real Estate Podcast. I'm your host, Sam Popple, my co-host, William McClellan. How you doing today, Will?
Hey man, yeah, it's all good. What's happening?
Uh,
Sorry.
oh
Uh,
yeah, Will's car got hit, and so he's running a little bit behind. That's why you're not seeing his face quite yet on screen, but he'll be on screen with me shortly. But today we have an amazing guest. I've watched this guest. I was in a real estate club with him for a while, and I was on the other side of a Zoom watching him talk about some amazing deals and always giving some great information. So I'm very excited he was able to give us his time tonight. But Chris Skinner is the managing partner at Blue Door Capital Group and a seasoned real estate investor who's been active in the space since 2007. Chris currently holds 72 units as a general partner in Panama City and single family homes in Tennessee. And then he's also an LP in multiple multifamily deals, totaling over 600 units across the state of Florida. What really sets Chris apart is his deep expertise in tax strategy for real estate investors. Over the past decade, he's helped more than 500 clients save over $300 million in taxes and using tools like cost segregation and strategic planning. Today, we're going to dive into how investors can use a tax strategy to accelerate wealth, structure smarter deals, and keep more of what they earn. So without further ado, welcome to the podcast, Christopher Skinner.
Thank you for having me. Appreciate it.
Hey, welcome to the show. So, Chris, for listeners meeting you for the first time, can you give us a quick overview of your background and what you do today?
Certainly. So, back when I was extremely young, I started working at, I know this is kind of ridiculous, but I started at McDonald's at the age of 14 years old, back when you got a worker's permit to be able to leave school, to be able to do that. And that's where I learned how to do suggestive selling. That's how they taught it. So I don't know if you know the story about Ray A. Kroc, who owned McDonald's.
I love the movie The Founder. That was a great movie.
He cleaned the bathrooms. Okay. So he did everything. He knew everything. And that's one of the things I wanted to know is I wanted to know how to do everything, not just how to take someone's order at the front desk, but how everything was being cooked, the fries, the kitchen, how that all worked, how the money was being transpired, all the equipment, just everything. It's just something that I wanted to always do. And as I grew out of that, fortunately, I got into telemarketing sales, and I started out as a TSR1, where I was actually on the phones selling printer ribbons. Now, we're talking about printing supplies from a long time ago. This is before LaserJet printers were even in existence. So we still
use the ribbons in my restaurant receipt printers. So I know what you're talking about just from that.
It's rare because most of the time it's done by thermal transfer onto a piece of paper now. But with that being said, learning that particular part of the industry, went through a training on that for about 2 weeks. The comedy behind all that is that when I was working for them for 2 weeks on the training, their job was just to have me get them interested on the phone, and then managers. This is a boiler room. I didn't even know that it was a boiler room. Again, you're young, you don't know these things. Mm-hmm. So they get them interested. They have the managers that would come walking around saying, "Okay, you got somebody." They'd come to the phone, and they would start acting like as if it was me. I was like, "Oh my gosh, these guys are trying to talk like me. This is crazy." So they would take over that, or if they could not, and it was a completely different voice, and they say, "Hey, this is Chris's manager. I'm here to fill in. This is the, I see here that you need 6 ribbons or 12 ribbons. Here's the price, blah, blah, blah." And I watched them do this for about 3 orders that day. The very first time that I was talking to them, I said to them, "This is easy. I don't need you guys to come in here and do this. Just give me the price and I'll take care of it." They said, "Oh, you think you're a hot shot, huh?" I said, "No, I've been around sales for a little bit. I know what to do." So I said, "Okay, we'll let you go ahead and do it." Well, I closed 10 orders that day on my own. Well, what I didn't know is over the course of the 3 years that I was working in that particular space and working for that company, there were pink boys that would take the slips and they would give it back to somebody in the back room, and they were calling them and saying, "Okay, thank you very much for your order. We're going to send out 24 to 48 ribbons to you. We'll see those, and here's the address, blah, blah, blah," and they'd hang up. So they were sending out more than what we were selling them on there. So I had learned a long time ago the sales phase. That was
Mhm.
in itself was fun, just being around those that didn't know what they were doing. 70 people were rushing to a job every single day for 6 months. I was afraid I was going to lose my job every single day because there was managers that were up in a booth that were listening to the phone call. They'd be turned this way and they'd be looking over there, but they're actually listening to me over here.
Oh,
So,
wow.
and if I didn't say something correctly, they would actually turn off my microphone on my phone and take over the call.
Wow.
Oh,
So
man, that's crazy.
that is crazy. Where was this?
This was in Moore Park, California.
Okay. Wow. That is. You guys were making some sales though.
So
had no other option, I guess.
yeah, no, and so they let us all go. There were some rough times that had hit, and so they let everybody go. But they liked the way I sold, so they called me back and they asked me to sell the Merit OSHA manuals. These were manuals that restaurants, like you're talking about with restaurants, that had to be OSHA compliance. So we had to sell these books. They were $450 a pop for them to make sure that they were OSHA compliance, rather than paying for a large company to come in there and do. Is a lot less expensive for them just to have some office manager taking care of filling out the books specifically for their business. So I was the top salesperson in that space for a little bit, and then they let that program go. And then they called me back again and asked me to be a TSR3, which is having existing clients. And that's when I found out about the Pink Boys. And when I was selling 72 to 144 or 2 grosses of ribbons, they were trying to double everything I was sending out. So when I had clients that were my existing customers call me back, I didn't like what was happening. And with my integrity, I just wasn't going to do that. I wasn't going to play that game. So then I ended up working in manufacturing companies where they were actually building the ribbons from scratch. I actually was being trained by an owner of a company. He's probably long past by now. He was in his 70s when I met him. That was 28 years ago. So at that time, he was responsible for the Hitachi Burroughs wide line re-inking machine, where he developed the re-inking machine to actually take those large nylon ribbons and re-ink them, or put more ink on them that were either foil or bar return, that were in those big high-speed dot matrix printers. And I walked into his office one time and he was speaking in Cantonese. I was like, how are you? What? This white guy with gray hair is speaking Cantonese in full-blown conversations in Hong Kong. And I realized that that's where he had all of his relationships. That's where all the product was coming from, was from China. So everything that was coming into the United States, it was being manufactured in the United States, but all the supplies and the parts and components and ink and everything was coming from overseas. Well, the HP LaserJet 1 first came out. He was the pioneer that actually started the industry to where we now have high capacity and low capacity ink cartridges and toner cartridges today, because he actually developed the HP LaserJet 2 jumbo yield cartridge that was in a green plastic mold, where he infringed on an HP patent. And HP says, you can't bring that into the country anymore. You've broken patent law. We're either sue you. You can either send it back and stop bringing it in here, or we're going to fine you. So he stopped doing that. And that's where HP got the idea of doing that. And now the industry today is what it is because of that. Fast forward to 2007, I got into financial services. The industry was starting to get very cutthroat. And that's when the crash happened in 8 and 9. I had real estate at that time. I had started buying single family homes to rent out. And so that's where my career started. But prior to that, in 2001 is where I started my own business. That's the year where I lost my mother, and we had September 11th happen. 2 months after that, I lost my job because we were supposed to go to a trade show in Vegas, and we couldn't do it because everything was grounded. All the flights were grounded. Everything was shut down. I had my mother and father-in-law that were here. They could not even leave because there was no flights. So they waited 2.5, 3 weeks before they even went home, and they had to go home on a train because they were too afraid to fly by that time. So I literally started my business grassroots out of the garage of my home. When I was let go, I literally was now selling wholesale to companies across the country at this point.
Mm-hmm.
I had worked for New Code International, which was a large manufacturing company. It was producing 70,000 laser toner cartridges a month out of that facility. And so I went to a smaller company and I was making decent money there, but I got tired of working for other people because they were taking advantage of what I was doing for them. So for the last 25 years, I've been blessed to be able to work directly in my home and take care of a family of 2 boys and now have 9 grandchildren.
Oh, dude, that's amazing.
That is amazing.
That's awesome. So at what point did you decide real estate was going to be a major part of your investment strategy?
Great question. So a decade ago, after this whole issue with 2007, 8, 9, the crash, and had gotten my life and health insurance license, that's when I got into financial services because I wanted to teach people on how to properly prepare for retirement. And a lot of that had to do with real estate, but it also had to do with the fact that the real estate that they were buying what they could not afford. And there was a lot of equity in their home that they were using to buy boats, toys, cars, going on, lavish trips. They weren't paying attention to what was really going on and the warning signs that was going on. So I started to do that. And once that hit, nobody wanted to talk to me about money. Fast forward to 2015. I went back into the financial services space again because everything had kind of settled down again. I started working with a company, not for them. I'm not an employee for them. I'm an independent contractor, but it's a company based out of Austin, Texas. And that's where I started doing cost segregation, research and development tax credits, because those that were looking to get insurance policies on themselves, these were business owners that I was contacting and had relationships because of me being in the imaging supply business. I built a lot of relationships with those businesses that were underinsured, but they also were not taking advantage of things that they could have. And so our company morphed into all services, from doing insurance to tax advantages. And now today we have tax strategists where we can actually help clients on a massive scale reduce all of their taxes. It's not just cost segregation and R&D. The reason why that you heard me, or I told you about the 300 million, was because when the pandemic hit in 2020, we had to completely we had to shift gears. We were doing cost seg and R&D massively for our clients, but we had to change because businesses were going to be shutting their doors permanently if they didn't have a way to keep their doors open. And the CARES Act bill that was passed allowed businesses to be able to apply for and secure up to $26,000 per employee that they kept on the payroll that was employed. Now, if they let them go, they didn't get those funds. So the government was incentivizing them by giving those funds for them for 20 and 21 combined of up to $26,000 to keep them employed. So during that period of time, I helped well over 500 clients save over $300 million.
Wow. That is incredible. Now, so I know today your portfolio, you have 72 units as a general partner in Panama City, some single family homes in Tennessee, then LP positions and other multifamily deals. How did you build that portfolio over time?
Great question. So I got back into single family again, and I started to realize that this wasn't going to scale. So the individual that we all know very well, I was listening to a podcast because I was just trying to strengthen in my information pertaining to cost segregation, because I started to get back into that in 22 when things started to settle down. And in 23, when I bought my homes, I actually did cost segregation on those 2 single family properties that I started renting out to traveling nurses, their midterm rentals. So when I did the cost segregation, I was able to share with my clients that not only was I selling this service to my clients, I was also a customer of it. So it made it a lot easier for me to have that conversation. So to answer your question, once I heard this podcast, it was actually a Black lady that was actually she was an auditor for 13 years for the IRS. And this mutual person that we all know, she was talking about him, specifically about his jet that he had purchased in 2021 for $57 million. And she was talking about bonus depreciation and told him that if you put it into service for 2 hours, you can write off that whole jet for $57 million. So those tax advantages that are available, there are 700 federal and state incentives of business, 700 federal and state incentives, excuse me, that's available to business owners and individuals that they don't even know exist. And the reason being for that is that the IRS isn't going to knock on your door and say, hey, you didn't take your R&D tax credits this year. Hey, you didn't take the oil and gas. Hey, you didn't take the Augusta roll. Hey, you didn't do the fee simple. There are so many different things out there that people don't even know that exist that can actually help them. And that's one of the things that most people don't understand. You've got Elon Musk, you've got Trump, you've got Bezos, you've got Ray H. Kroc that own McDonald's. You've got all these people. It's not about the services they're providing, it's the real estate. And that mutual individual for thousands of years, we've been dealing with real estate across the world. So when you buy real estate in the United States, it doesn't matter if you sell it and then buy it again, you can still do cost segregation every time on those properties. So that's where I got led to this individual, got into the real estate club, and I started to realize that there's more ways to skin a cat, because building single family homes is not going to, I'm not going to be Rich Dad, Poor Dad with Robert Kiyosaki, where I have to try to scramble to get 12,000 homes like he currently has today. Mm-hmm. It's just easier to do it when you're doing multifamily, because if you buy 100 units and you have 10 people leave, so what? You're 90% occupied. It's going to take care of the debt service. So learning all of that.
Before we get too much further, I do want you to kind of break down a little more what cost segregation is.
Sure.
For people that are maybe newer to real estate and stuff. And honestly, like we're probably going to do our first cost segregation this year on a rental that we kept out of our new builds. And so I'd love to hear a more clear breakdown of what it is.
Sure. Yeah, and I'm also going to add to that. You listed, or you mentioned 700 different tax strategies, and then you kind of gave a handful. R&D, and you specifically said IRS isn't going to come knock on your door and tell you, hey, you need to collect this oil and gas, etc. That you just mentioned. So if you kind of want to go in on cost segregation, but maybe your top 5 strategies that people could be using today that aren't for smaller businesses. Because again, guys, I don't know if you heard.
Are you meaning
$300 million on 500 clients is pretty impressive. Nearly $1 million a client, let's just say, or $500,000, more than $500,000. Easier to say it that way.
Yeah, our company did $2.2 billion so far.
Right, exactly. Incredible. So if you kind of want to go high level there,
sure.
I think for the listeners, that'll be extremely valuable.
Sure. So you want to talk about cost seg, or are you going to talk about R&D? Which one?
Let's start first with what cost seg is, and then
sure.
go into the R&D.
And then kind of digress into it. Yeah, exactly.
Certainly. So cost segregation is very simple. It's been around since 2004. It's actually been around for over 50 years. But the problem is that most people don't understand that there's been many laws that have been passed to where things were made a lot easier now, to where bonus depreciation was at 50% all the time. Just it's never discussed. I want to say this one thing before I get into it, is that think of your CPA as your primary care physician. And this is no offense to any CPA out there whatsoever. They're professionals at what they do. They're important to have. They're going to help you. The challenge is they're always looking for something in the past, not anything that's in the future. And so that's where tax attorneys and tax strategists come in. So think of them as your primary care physician. And if you've got a heart problem, you want to go to a heart specialist. So that you're going to need a specialist on this. So cost segregation is accelerated depreciation. So when you buy an asset in the multifamily space or single family, it's doing straight line depreciation is what a typical CPA will do over a course of 27 and a half years. And what most people don't know is if you're renting out another property that you're doing Airbnb, they classify that as a hotel. So the asset class now becomes 39 years. So there's a lot of nuances to that. But the accelerated depreciation is being done over 5, 7, and 15 years. You're never losing the remaining part of the straight line depreciation for 27 and a half years. But if you have a commercial building, that's 39 years. So when you buy these buildings, you have these depreciation schedules that have been set by the IRS for years, but nobody's taking advantage of it because they don't know that it's available to them. And here's why. Going back to the CPA statement that I made, it's because they can't do it without an engineer. It requires a cost seg engineer study and a report, because basically what's happening is everything that's within the four walls of the building is being spreadsheeted out, and it has an asset class that's got its designee for it. So carpet, flooring, electrical, plumbing, appliances, the walls within the building, lighting, everything that's inside that four walls has to have some kind of a depreciation schedule. So when an engineer is doing the study, they have to spreadsheet that out. And it's a 30, 40, 50 page long report on that particular asset. So the CPA then takes that information from that particular schedule and creates a depreciation schedule that allows you to accelerate the depreciation over 5, 7, and 15 years. The 15 years part of that is the land improvements, because land is not depreciable. When you're doing anything pertaining to cost seg, it's very important to have that study, make sure that the CPA is actually doing the depreciation schedules correctly. And you also want to make sure that you are getting audit defense protection to make sure that it's been done correctly, because you are within risk of being audited if it's not been done correctly, and you have a 3-year statute of limitation under 44C3 of the IRS Internal Revenue Code. Now, all this information I'm telling you, I am not a CPA. I want to be clear and upfront on that. So I'm not giving any legal, financial, or tax advice, but I just wanted to let you know that that's how it's done. But bonus depreciation, Trump put into effect in 2017, the Tax Cut and Jobs Act, which allowed bonus depreciation to be at that 100% that we talked about with that individual who bought his jet and wrote off that jet. Well, you can do the same thing with cars, but you can also do the same thing with your assets. So if you have a single family home that you're renting out, if you have multifamily, if you have a triple net lease on a corporate building, a medical office, auto dealerships, oil and gas buildings, and they all have their own asset class on what you can get as far as the tax benefits from it. But the most important thing is making sure that it's done correctly. Now, the one thing I left out, though, is bonus depreciation. Bonus depreciation allows you to not the acceleration's already happening, but the bonus depreciation allows you to take that in the first year if you choose to do that. One of the things that's very important to know is that if you're going to buy an asset and you're going to flip it, don't do it. If you're going to buy the asset and hold it, you're going to want to do that simply because you could have recapture. And what does recapture mean? Recapture means that everything that you took from the tax benefits from that, and let's say you held it for those 5 years, but you sold it in 3, you're going to have a recapture, but it potentially could be fractional. And think about it from this point of view. You have $1,000 refrigerator that you put into the building. It's not going to be worth $1,000 3 years from now. It could be worth maybe $50, $100, who knows? So those are all things that have to be taken into consideration, but the benefits outweigh any of the consequences, because when you buy these assets, you definitely should do it every time you buy one, because you're going to turn around and continue to keep doing that. And as you continue to do it, you're going to have this building up on your ledger that you can actually use to offset federal income taxes. And that's the reason why those large companies have never paid federal and state income taxes. And that's because of that. And the other one, from the digress here now, which is research and development tax credits, in 2019, Amazon received $439 million in research and development tax credits and paid $0 in federal income taxes. And that was in Bloomberg and Newsweek and everything else. And that was in the CPA Journal, by the way.
Wow. No, I mean, yeah, that's amazing. It's definitely an incredible tool. Yeah, and I did read something how I think something was brought back recently as far as that bonus depreciation. Did I understand that right?
That is correct. So the big beautiful bill that was passed in January 19th of 2025, it went into effect. So anything after January 20th of 25, you can now purchase buildings, do the accelerated depreciation as normal, because cost segregation was never changed, but it was bonus depreciation that was scaling down. It was going from 100% in 22, 23 was 80. Then in 24, it went down to 60%. And then 25, it was going to go down to, or 24, excuse me, it's going to go down to 40%, and 25, 20%. In 26, it was going to fall off. But he put it back to 100%. So this is the time to buy properties again, because you can take that in the first year rather than spreading it out over and amortizing over 5 years, or spreading it over 5 years on the 5-year bucket, and then the 7-year bucket for equipment, and then 15 years for land improvements. You can take it and accelerate it all in the first year.
That's amazing. Now, what are your top 5? Because you dropped some of the deductions and everything. What are your top 5 favorite deductions that you think a lot of people don't take?
The top 5: research and development tax credits if the company can take it, cost segregation, the Augusta rule. If you've got taxes that are facing you, you can do fee simple. That would probably be another discussion for another day. But there's fee simple. There's energy 45L energy credits, because those that are in the real estate space, some of them are developers, and when they're building hundreds of homes or thousands of homes, you can get $1,500 in tax credits if you make them energy efficient for each home that you build out, and that's a refundable credit. Those are pretty much I would say those are the top 4.
Okay. No, that's definitely great to know. Now, who benefits the most from a cost segregation strategies?
Any person who is purchasing a property that's acquiring. It doesn't have to, it could be used, it could be new, it doesn't matter. Anyone that is going to buy a triple net lease building and they're going to rehab that into a restaurant, they don't have to own the building to do a cost seg study. So there's a misnomer that you have to actually own the building to do that. You don't.
I did not know that, and I have 4 restaurants. That's really
you
good.
Own 4 restaurants.
I own 4 restaurants. Yeah, so
you and I need to have a conversation.
Yeah, no, that is amazing. Yeah, we were just talking about who benefits the most from cost segregation strategies. So
yeah, it clicked me off whenever I was connecting from mobile to my laptop. But I heard if you want to buy something and flip it, don't. And then I was like, no, don't click off.
Yeah. These tax strategies are only good for the stuff we're holding. So
sure.
Now, how should investors think about tax planning when acquiring new properties?
Say that to me one more time.
Yeah. How should investors think about tax planning when acquiring new properties?
Well, first of all, if they're making decent income already, and they're going to be moving into anything pertaining to being a real estate investor, you're going to want to document the hours if you don't plan to become a real estate agent, because then you can earn what's called rep status if you put in 750 hours into it and you're truly doing that and you're documenting everything you're doing. But please make sure that you talk to legal, talk to a CPA, talk to a tax attorney to make sure that you're following all those rules. But that's what gives you the benefit to be able to take advantage of those tax incentives, because if you own the property, but you also work a W-2 job and you're spending 15 hours a week and you can prove that, it could potentially offset W-2 income.
I need to talk to you on that.
All those dollars, Will, we gotta log that.
I actually started using a company called Driver's Note, and they send me a beacon that tracks a lot of the driving, showing going from property to property and location to location. But I need to combine that.
There's an application, Will, that you can use called RepStacker.
RepStacker, I love it. I'm writing it down right now. RepStacker.
So you've been involved in multifamily deals across Florida. What attracts you to buying multifamily?
Multifamily is that's a lower barrier to entry. The fact that you're having property managers manage the asset rather than taking care of the toilet bugs and the tenants and the night calls and air conditioners going out or something going on with the property, or somebody drove into your into the garage door and you've got to get somebody out there to fix it, whatever the case may be, electricity going out. These are all things that you can have a property manager take care of. And also, this is a team sport, guys. You already know this, but you must have a good team. And one of the things that I will stress more than anything, it's not just the deal, it's the team. If you don't have the appropriate team behind you, it's going to make it that much harder for you to accomplish the goals that you're trying to do when you buy these particular assets. However, with that being said, you can make millions of dollars in this space very quickly if it's done correctly. So it's the underwriting, which is the most important part of it. Then it becomes how you raise the capital and the relationships that you're building and making sure that you do right by the investor, because if you put them first, you'll make your GP promote, or by being a sponsor, being able to earn that particular type of income. But it is not a get rich quick. It's a get rich for certain if you execute on the business plan.
Get rich for certain. I do like that.
Yeah, no, that's definitely the beauty of it. Now, what do you typically look for when you're evaluating a deal? You can tell me either as a GP or as LP. I'd actually kind of like to know how you looked at both, because since you have both positions in your portfolio.
Exactly, because you have to look at it from that perspective. Because if I'm going to invest in it, I need to know why they would invest with me.
Right.
Sure.
So what you're looking for is the upside. What is the upside? What is the rents that you actually can do on these? You have to be very careful and strategic on it, because if you do it wrong, you're going to start pushing people out of your property, and then you're going to have issues trying to fill it back up. And the banks don't like that. When you start falling below a certain percentage, you go on a watch list. So you got to be very careful. It's important to make sure that you have everything in place with attorneys, property management company that you're very comfortable with, all legal in place, making sure that you have everything structured properly, that you have a business plan set, your bios are completed, your SWOT analyses are done, because this is a business where this is a good old boys club, to be honest. Even though there's a lot of women brokers out there, this is still a good old boys club, and everybody talks in this industry.
Mm-hmm. Definitely. So now with the interest rates I feel like they're starting to come back down, but they're definitely elevated, from the early 2020s. And then Florida insurance, I actually know from experience, because I live here, I've seen it in my own policies come back down a little bit this year. The last 2 years were uptick. The last 3 years were uptick. The last 2 were my biggest upticks, but finally seeing it come back down. But with insurance being high in states like Florida, like Texas is another one that I know has it. Yeah, how do you navigate that in the underwriting?
Very good question. So with Florida properties, you need to make sure that you give yourself a buffer, and it's typically you want to outpace inflation. So you want to equalize that with your expenses to what the inflation is on raising the rents organically, rather than actually forcing the rents above that. So when I underwrite, I'm underwriting at 3% inflation and then 3% expenses. Depending upon the market, it could be 2 and 2. So you want to keep them equal so that it continues to grow over time as far as what your taxes are going to be every single year. But for Texas, for the sake of talking about Texas, it's not really my market. Mm-hmm. However, I do understand that in the Texas market, you have to fight for the taxes that you're going to pay every single year. You have to go through an appeals process, hire attorneys to do all that, real estate attorneys. to go and fight for it. And it's a constant battle that you have to do with that on a daily basis. But as far as the insurance is concerned, you want to make sure that you have the right companies that have the right carriers. You make sure that you have the right coverage in place, depending upon whether it's on the West Coast, if you need earthquake coverage, if you're not in a flood zone, if you get a lot of bad weather, you want to make sure that you have some flood coverage in certain circumstances, because you never know what could happen. And you don't want to have that happen to you when you've got a big event and you've got to call in to the insurance company and say, hey, I'm going to have to file a claim, rather than just taking it from operating expenses to take care of it, rather than paying that deductible and then having that hit your record, because then that starts to go on the reports, and then you have to disclose that information when you go to sell the asset.
Sure.
Mhm.
So remind us again, quick underwriting, you're going 3% inflation, 3% for
Typical for expenses.
just across the board. And that's just going to be typical, even if you're giving yourself a 1 point buffer,
Correct.
a typical 2%. So, and then a high level for underwriting outside of just 3 and 3, take us through that process for the listeners on when you're doing a deal and you're analyzing the deal and you're saying, this is the one that we're going to go for, or this is the one I'm going to present. I'm going to be a limited partner, or I'm going to be that general partner.
It's a good question. So, because again, you're going to have to share your underwriting sometimes with really astute investors in this space,
Right?
Because they're going to understand this, and you have to be very careful with what you're saying and what you're telling your investors.
Mhm.
So in our underwriting, it's extremely critical that it's not just about what the going in cap rate is. You also want to make sure that your exit cap rate is actually higher than what your going in cap rate is, and to see if it stress tests that you can actually make money on the property. So what I do is what's called spreading the seller's numbers. So I take the P&L and I plug that into the software, and I spread those sellers' numbers, but all those numbers are not going to carry over, because some of them are either going to fall off or they're not going to pertain to me. So then I have to then understand my market. That's the reason why that a lot of people that are in this particular industry are always trying to chase the next shiny penny in some other area, because they can't find something in their own backyard.
Mhm.
But you need to find 2 to 3 markets and know them really well. So when you start to know them really well, you start to understand what your expense ratios are going to be. You understand what it's going to cost for an attorney. You understand what it's going to cost for the property management company that's going to take care of that. You understand what you're going to pay in insurance, and you understand what your tax liabilities are going to be. So the difference, and I'll give you an example with properties here in Tennessee, taxes don't get reassessed for every 4 years. In the state of Florida, it's every year.
Mhm.
So knowing your market is extremely critical. But the other part of that too is making sure that you do a proper rent stack or rent analysis. You need to know exactly who your competitors are in the market. If you don't, it's going to bite you in the butt, because if you don't what they're charging down the street, once you take over that asset, they're going to know. People know in their market what's being sold and who it's being sold to, and they're going to do research on them, because they are going to know that there's competition coming in that's going to start either raising the rents, or they're going to drop the rents because they want to keep the tenants happy. And then it causes people to move and transfer over. So you have to understand where the migrations are. You have to do a study. So through CoStar, for an example, I'm getting market condition reports that tells me everything that's going on within the market. Those are great reports to have. Not every single OM is garbage, but there's a lot of garbage information in there, because at the end of the day, the broker's trying to sell the asset.
Sure.
So you have to identify all the challenges that are in those OMs, and you have to come to a conclusion that when you're doing the underwriting, that you can feel comfortable and confident that when you go to put your offer in, the offer is as good as you can potentially give it, considering the fact that no one has a crystal ball to see what's going to happen 5 years from now, let alone 10 years from now, or even 2 years from now.
Right.
But you still have to start with the base, and the base is the going in cap rate, and knowing exactly what you can purchase it at the time that you're buying it. And then you have to be able to execute the business plan by making sure that you raise the rents, because raising the rents and other income on the property is where the NOI changes the valuation of the property, as we all know.
So with all that being said, understanding markets, tracking markets, seeing where migration patterns are, but taking 2 to 3 key markets that you really understand, because I wrote down a couple things here high level. You really have to understand tax liability, attorney costs, insurance costs, property management costs, going in cap rates, exit cap rates, so that you can underwrite properly, go through rent analysis, have a good understanding of your overall expense ratio, and then from there you can start understanding the property, the buy on the property, building the business plan, understanding the SWOT analysis, insurance analysis, and then equalize it. Once I have that, and I've kind of understood, I only look at this market specifically. Are you still looking? Oh, can you hear me?
We can hear you, but we lost your picture.
Oh, that's strange. Understanding your market specifically, are you still going after deals outside of those markets, or are you just sticking with those 2 to 3, and what would those be? I like for one example, and one thing that I just heard is you said, oh, well, Tennessee, you're only getting every 4 years a new tax assessment. I mean, that's something that really stinks here in Florida, and you'll see a lot of people buy new construction homes or things like that, and then you see this house that's 2 years old that's getting foreclosed on.
The new construction one is where people get blasted.
Right. So with that in mind, and all of these notes that I just took, what are your 2 or 3 go-tos? And then outside of your go-tos, how are you assessing the migration patterns to get outside of those 3 markets?
Well, within the migration markets that I'm looking at, so in Tennessee, Knoxville area, I'm looking in also in the surrounding, not in Nashville directly, but the surrounding cities of Nashville, because a lot of migration is changing where people are leaving that area because it's costing too much to live in that area. And then also for Charlotte, North Carolina, Raleigh, North Carolina, and then of course the Tampa area, certain areas of Aventura, Miami area. But most of the properties I look are in Clearwater, Tampa, and then areas in the Panhandle, because they're not being touched.
That's our home, man. So we're gonna keep our eyes open and give you a call when we find something.
That'd be great. I would love to hear about it.
Our GP partner.
I'd love it.
Yeah.
Let's go.
Definitely.
No, I mean, that's something that was so interesting when I was reading the bio and what Sam had presented to me. I know you guys have talked previously, and I was like, Sam had called me and said, hey, do you have any questions or anything you want to go or review? And I said, well, he's got a huge apartment complex, 60 miles as the crow flies away from us. Like, there's so many questions. Like, how did he find the deal? What is he doing? Why is the Panhandle a critical market that he's focusing in? I mean, we do here in the Southeast, Knoxville, outside of Nash, North Carolina in general is hot. So I heard you say Charlotte, Raleigh. Everyone, when they're looking at Florida, they're saying, oh, you live in Florida? I'm going to Miami next week. I'm like, okay, that's great. That's 12 hours away from me.
We currently live in Pensacola, but I actually grew up in Destin, right next to Panama City. So, yes, I know exactly where you are. Over there.
Got it.
But I really love the fact that you have things in the Panhandle, because I made the joke about Miami, but it's kind of the same to Tampa. People are like, oh, I'm going to go to Miami. I'm going to go to Tampa. Can you have lunch next week? I'd love to. But you live in Houston. It's just as close for me to see you in Houston as it is in Tampa. Like, Florida's just so big. It's kind of like Texas, you know, and they think, oh, well, if I'm not going to visit you in Dallas, even though Dallas to Houston, if I was visiting Dallas, would be actually closer than them going to Tampa. But I love that you're in the Panhandle market. And you mentioned something there that it's getting overlooked. Definitely enlighten us, because we have a lot of listeners here in the Panhandle, and I'd like to create some lead generation on how we could have you as a general partner. We could lead and boots on the ground, looking at things and be able to help you and then learn from you. That's the biggest thing.
Well, I was at a summit that was pertaining to capital raising. and I was listening to somebody who's raised over $3 billion in private equity. And one of the guest speakers that they had was Ken McElroy. And I don't know if you're familiar with who Ken McElroy is, but he's another billionaire that's in this space.
Mm-hmm.
And he has talked about Florida and Texas, and he is saying that the majority of the state is cooked. So what you need to do is you need to find, and I'm not saying that that's, set in stone. That's just his opinion. I'm just telling you what I heard.
Mm-hmm.
So based off of what he was saying is that you want to find trends where people are moving into areas that may be into tertiary markets that they're not even looking at. So when you've got everybody all migrating to try to find something in Miami or something in Tampa or Clearwater because it's so overly populated to the point where you've got so many properties out there that you can't even build anymore in certain areas.
Sure.
So that's great and that's fine, but you're also buying asset classes that are in the 60s, 70s, and early 80s. And so there's a lot of challenges with some of those properties, especially with it being near seawater, where you've got maybe cast iron issues. So if you're going to buy assets like that, you need to get them quickly and get out of them quickly. Because if you hold on too long, is where challenges could start happening. And then you can start having problems with not being able to return money to investors because you start running into challenges with the property and then it starts consuming you. Mm-hmm. So you want to look in markets where there's a lot of migration happening. Like I told you, anything over 1.2% year over year growth is important to be looking at and to see what's happening, who's coming there, what businesses are coming in. So in the markets that I'm looking at in the area around Nashville, there's a lot of LG Chem plants coming in. There's a lot of Amazon coming in, industries coming in. There's a large tire manufacturing company that's built their 5th plant there. So there's a lot of migration that's moving there. And believe it or not, in that particular area, I don't want to mention the name of it right now, just for the sake of protecting the innocence of what I'm doing there. But one of the challenges that we have is that we're also having challenges getting the minerals and mining the minerals that we need. And Trump just passed a bill where 2 major cities are allowing that to happen. So that's taking place right now. So it's creating jobs. So when you start seeing jobs happening in your near military bases and things like that, there's also the scare of when you're buying military. So that's the catch-22 when you're buying properties that are near military. If there's a lot of concentration of military, Freddie and Fannie don't want to touch it. If it's overpopulated in military, simply because of the fact is that there is a law that if you get deployed, you have to break the lease. Mm-hmm. So if you got over 50% in there, and you've got to let them all go because we've got a war going on right now, guys. So if they have to be deployed, you could be 50% occupied and you're in trouble because then now you're having to scramble to find people to take over those units. And sometimes you may have to give concessions to make that happen. So that's another part of my underwriting is making sure that I factor in concessions, even if they say, I don't offer any concessions. Well, I'm going to underwrite to that to be conservative. Because there's a difference between economic vacancy and true vacancy.
Mm-hmm. And when you say concessions, do you mean like a free month of rent, or what are you talking about? Just for a new list?
Depends on the market.
Okay.
So if you've got a market that's extremely aggressive on the rents, some people will offer 2 months. Mm-hmm. Some people are actually offering $300 or $400 off the rent for an entire year.
Oh wow! I have seen a 3 months no rent for a move-in special before.
I've seen not 3 months, but it comes out to being that when you give $300 or $400 a month off for the entire year because it hits the bottom line on your NOI.
Yeah, correct. No, that's that would definitely be an issue.
Yeah. When I was in the Atlanta market, that was not uncommon to see 2 months free rent, especially with all the new building and there's new Class A, and it's like all they're trying to do is get that thing rented, pre-lease deals and everything. It's like lock up your contract, but you're gonna live there way cheaper than the place next door because we're gonna give you 2 free months, $1,000, this and this. It's like, whoever's kind of
What
getting
I
to
saw
that
a lot
bottom line.
was the Austin market too. I know did a whole lot of moving incentives when they had a whole lot of units come online. Whenever
Yeah.
I was doing some research over that way, so no, that's definitely. So how do you how is you? So you just factor in that everybody's doing it in your underwriting.
You have to.
Yeah,
Because then here's the thing. If you can underwrite to it and it cash flows and you can stick to the parameters, and I like to stick to about a 1.8x multiple over a 5-year period of time. I don't even talk about IRR. It's too confusing.
Mhm.
It's very easy to explain this. If I can give you, and it's projected and it's targeted to give you 20% annual rate of return over the next 5 years, that's a 2x multiple, right?
Mhm.
Mhm.
If I can help do that and an average plus or minus of a 6% cash on the returns over the next 5 years, would that be something of interest to you? Sure. Because 20% ROI that you can actually project, even though it's conservative, doesn't mean that you can't supersede that.
Right.
So if you're conservative in your numbers and you do a 38% in that first year, or even if it's your second year, then you've excelled beyond what you told the investors that you were going to do. You have to underpromise and overdeliver.
Right.
But that doesn't always mean that that's going to happen, though, because there's never a guarantee in real estate.
That's the truth. So if someone was just getting into real estate investing today, what's the first step that you recommend for them?
Learn the markets, learn how to acquire an asset, and the first thing they need to learn how to do is underwrite. Every single person that comes into multifamily is trying to just jump into the calls, jump into networking, trying to find partners, trying to find deals, and they know nothing about the numbers. The
Right.
numbers tell the story, period. And if you don't understand those numbers, how are you going to be able to convey that information to an investor? It is very critical to have that under your belt. So learn how to underwrite is the first thing. And the second most important thing is to learn how to raise capital. And how to learn how to raise capital can be taught, but it's also in how you deliver the message to someone. It's not just necessarily the exciting pictures that you're going to show. It's the conviction that you knew those numbers when you're pitching the deal to them.
Right.
That I'm confident that I put my money into the deal, just like you would be putting your money into the deal. And my job is to make sure that you, Mr. or Mrs. Investor, is receiving the returns or the targeted returns that we are trying to get for you. There's never a guarantee.
Mhm.
So actually, I have a question. Learn how to underwrite. Learn how to raise capital. Is there a way
we
that
lost
some of
you.
our listeners or anything?
What? Can you say that again, Will? You broke up a second.
Oh, yep, sure. My question is, you said first learn how to underwrite. Second, learn how to raise capital.
Yes.
Is there somewhere that Sam and I and our listeners can learn that with you or learn from you?
Sure.
Yeah.
I'm actually building out some things right now. I don't want to give away the farm right now, but there's some
I
things
gotcha.
that I'm working on to actually help that, because yes, there are many mentors, there are many individuals in this space, and they give it to you from a 30,000 foot view. Some people will get into the weeds and teach you how to do things in the weeds, but there's a lot of people out there that can't afford to spend $25,000 to go through course materials to get that. So there are things that I'm going to do to help educate those that I've learned over the last 3.5 years that I've focused on that, and have spent a tremendous amount of money on my education and also putting in the reps of doing it, because I've had some mishaps where I've gone backwards. And it doesn't mean that you don't learn from them, because you always are going to learn from your mistakes. But it only just makes you stronger to do that. There's a lot of people I know that will jump right into it. They've just joined the group and they find a partnership and they get their first deal and they've never experienced that. So you want to make sure that you're teaching them the good, the bad, and the ugly, not just the positive all the time. There's things that are going on behind the scenes that are never discussed, and they should be. And how you communicate with your partners. That's why I said to you early in the very beginning of the podcast, is that we need to know who we're going to be doing business with. And you have to align on what you're doing. If you don't, it doesn't matter what the deal is. It's going to cause friction. The investors will see it. They're going to know what something's going on. The property's not being taken care of. And then therefore things start to fall apart. And then now you're on the chopping block of having to sell the asset, and the investors are at the risk of losing their investments. And I don't ever want to put them in that position. I would rather walk away from a good deal than get into a bad situation with a partnership.
I 100% agree with that.
So here's one thing that I'll tell you. We are always in a hurry to go out and find that next asset. We're excited to find something that pencils or comes close to penciling. Now you start getting into the art of the deal, which is what Trump talks about, and being able to negotiate that with the brokers and being able to go through all that whole process. But what we don't do is we don't underwrite the people we're going to do business with. You need to know. You need to know their background too. And I know I'm probably saying this on a public forum, but you need to actually do a background check on the people you're doing business with, because you're going to be married to them for the next 5 years minimum.
Sure. No, I completely agree with that. And I think that's word to the wise, honestly. Yeah. And I'm heeding that warning heavily as we're starting to get, pick things up. And I think that is really good advice. I know you kind of dropped it there, but whenever things are up and running on what you're building out, because I know you said a lot of people are 30,000 foot views and some people are down in the weeds, but you're building something out on how to properly underwrite and how to raise capital. I definitely would love to have you back. Then you can dive into that kind of share what you've built out and what kind of courses you're doing or how you're implementing those and how people can learn, because that is something that actually Sam and I, we were just talking about last night, is like when you have the systems built out really well, it makes it a lot easier for other people to invest in the deal, because it's very easy for Sam and I to say like, hey, you can do it if you want, but like we're already doing it. We know it makes money. We'd love for you to be part of it.
We've actually had a few people give us their lots to build on, to do a split on the back end, because they saw that we're so much faster and more efficient than they could do it by themselves, that they'd rather do the deal with us and be done with it and get their money within 6 months than to try to do it by themselves and
drag it out and things. Yeah.
Team sport, guys.
Yeah.
Team sport. And we're ever growing. And I think so. You're more powerful in numbers, and something that I've really been enjoying is getting to know other people background, you saying that, and what they know, and then how we can elevate and build our systems out even better, because every business that we're talking to, each business and business model runs independently. And then once you kind of combine the good and then kind of eliminate some of the things that might not be working, and then delete that from your business, it's like, man, we're oiling this machine. It's working really well. But I feel like there's so much more to learn, and I cannot wait. Whenever you release that, I'm going to be one of the first people to hop in, because learning how to underwrite at a larger scale and how to raise capital and how we can build our systems more efficiently, I'm super excited. And I think you mentioned something also. It's like you have to pay, and you've paid for education. And we've had a number of people on here, and every time someone mentions that, I just reiterate it, because a lot of people, they don't want to pay for that. And then what happens is, and it's so cliche in this business, it's like, oh, analysis paralysis. You get stuck in what you're doing. Or it's the opposite, and you pay a whole bunch of money for this course, and then you don't do anything with it. And it's analysis paralysis that way. And I'm like, I hear that so much, but I can't wait to see what you're building out, and most importantly, be able to help anyway in any deals here in the Panhandle that we can view and put eyes on physically or FaceTime or whatever we can do, just so we can learn that process, even if we can't, you already have the deal full or something, but just like being, in that presence of mind and understanding that business model and being able to talk with you, I'm super excited, and I can't thank you enough. I don't know what's going on with my video, and I'm kind of bummed on it, but thank you so much, at least for dealing with me via audio, because this has been super exciting.
Fantastic. It was an honor, gentlemen. I appreciate you inviting me tonight to share this message with everybody, because you can do this. It's not for everybody, though. And that's the thing that people need to understand. There's a lot of people that are getting involved into this. And quite honestly, if 10% will be successful and only 1 to 2% will be extremely successful. And you already know who I'm talking about.
Gotcha. What's next for you in Blue Door Capital Group?
What's next for me is finding that next asset that's going to help my investors make some money over the next 5 years.
Will and I are going to start trying to hunt that down around the Pensacola area, so here in the Panhandle. So we'll see if we can help you make that happen.
Keep me posted.
Definitely. Where can listeners connect with you, learn more about tax strategies for real estate investors, and just more about the Blue Door Capital Group?
Fantastic. So my website is www.bluedoorcapitalgroup.com. They can reach me at Chris, CHRIS, at bluedoorcapitalgroup.com as an email. And they can reach me at 865-978-6746. And I'd be happy to have a conversation with them. One of the things that I think is extremely important in helping anyone on any of these services that I've ever been able to do is take it from an educational standpoint. And we provide a free analysis for our clients to determine how we could help them. So if you can reach out to me on that, I would love the opportunity to be able to share that information with them on a granular level that is specific to their needs. And I'm here to help any way I can.
Oh, man. Thank you so much. Thank you so much. And then also for tax strategy. And are you still doing that? You still
yes,
have that business?
Yeah, absolutely. That's my core business. That's what funds me to be able to do the real estate that I'm doing.
Right.
So they can reach me at 951-821-0405. And my email address for that is Chris at Impact, IMPACT, B as in Bravo, S as in Sam, G as in golf.com. And I represent a company based out of Austin, Texas. We have 27 CPAs, EAs, and tax attorneys from the top 5 national accountancy firms: Deloitte, Ernst & Young, Moss Adams, PricewaterhouseCoopers, KPMG. And we have an engineer that's been a CPA, a tax attorney, and an engineer, a cost seg engineer for 38 years. And we have a team of people underneath that. We can do that in all 50 states.
That was going to be my question. So you must have knew it was coming. So perfect.
Yes. Exactly.
Available. So no, we're definitely going to have to inquire about that with you. Before we close out, we always do a couple shout outs. So if anybody is listening and needs any kind of building supplies in the Panhandle, please go to our website, theeliterealestatepodcast.com, but just drop a message there at the bottom. Say, hey, I need some building supplies. Because Will, my partner, he is with Dufresne Building Supplies, and he can supply all your building supply needs everywhere across the Panhandle, from Fairhope, Alabama, all the way to Panama City, Florida. So, like I said, if you're needing any building supply needs in there, please shoot us a message. If you have any land deals specifically in the Escambia County area, anywhere around the greater Pensacola, Florida area, we are actively buying land deals. I think we put 6 under contract this last month. We're trying to put another 6 under contract this month. So I think we got a closing on Friday, trying to keep the momentum up, trying to get 26 new builds done in 2026. So please help us with that goal by feeding us some more land. So if you have any land in the Pensacola area, go to the EliteRealEstatePodcast.com and shoot us that message at the bottom. And please go over to the YouTube and hit that subscribe button for us over on the Elite Real Estate Podcast. Anything else, Will, before we close on out?
Just running back one more on Impact Business Solutions Group. Do you have a website that we could link and people could go to?
Actually, I don't personally have it. It's tied to the company that I work with, not for, and that I represent.
Mm-hmm.
if they want to reach out to me, it's best that they contact me directly, or it'll go to their website and they won't know, because if they go in there and they fill out the form, they won't know who to. It'll go to the corporate's main website.
Understood.
And if they reach out to me, I can share all that information with them. I'll be happy to give them all the information, the background behind our company. We've done well over $3.5 billion of recovery for our clients over the last decade. We did $2.2 billion on the ERC tax credits. So these are the B words, not the M word.
Right.
So on the billions, we're a very reputable company. We've done tremendous work for a lot of companies, and we've helped businesses keep their doors open for the last 3.5 years during the pandemic. So I'm very grateful that I've been able to do that, and it has afforded me to be able to do my real estate journey.
Amazing. Well, I'm sending you an email right now because I already looked up, as we were talking about, Reps Tracker, and I'm like, oh, okay, this is already worth thousands of dollars right here for tax strategies for next year. And that was just like one quick blur that you made, and I just wrote it down. So scheduling a call with you, I can only imagine, and your team, and that goes for any of the listeners. I mean, that one thing is going to change some huge tax savings just off the rip. So anyone that's doing new, especially new construction or fix and flips where there's high taxes incurred instantly, definitely reach out to Chris.
Absolutely. There's many things that we can do to help mitigate taxes, because I've been down that road where I did not have these services and I had to face a high 6-figure tax bill. And ladies and gentlemen that's listening to all this, you don't want to have to deal with all that. And there's ways to mitigate that legally.
I love it. I love it. I love it. I'm already sending you an email. So
thanks, Will.
All right, Chris. Well, man, we really appreciate you joining us on the show. We appreciate everybody who listened this week on the Elite Real Estate Podcast. We can't wait to get back with you guys next week. So appreciate everyone listening. We can't wait to see, like I said, to bring you guys back next week. So thank you for listening in.
Thanks for having me, gentlemen.
Oh, Chris, thanks for being on. Appreciate it.
You bet. Have a great evening.
You too. See ya.
Bye now.